Hey there, everybody. Happy Monday to everyone. Hope everyone is doing well. No, I am not down on the floor right now. I am actually out in Colorado. Maybe tomorrow I'll change my background. Um, Hopefully, everyone's doing all right. And I'm pointing to my eye here, which those of you in any of our rooms know I had an accident over the weekend. No, my wife didn't punch me or anything like that. Had a little incident with one of my dogs, and my dog Kobe won. So if you see some black and blue in here, that's what that is all about. So thank you, Kevin, for smashing away. Can everybody? Yeah, Kevin, it's this is covered up pretty well. You saw what it looked like yesterday. So yeah, it's a little bit of a rough go there, but that's okay. I'm gonna just adjust my camera here. A sec. There we go. All right. What's the market doing right now? Actually, the S&Ps are just a tiny bit negative right now. They were down about 20 points on their low today. The Dow is down bigger, a couple hundred points. The Nasdaq is actually up. I'd say this is pretty darn good after the rally that we saw on Friday, but very quiet action today. Extremely low volume. As I had mentioned on my interview on Schwab Network earlier this morning, I think most people, firms, big institutions, probably just getting ready, positioning themselves for the NVIDIA results, which are Wednesday after the close, and then we get PCE, the Fed's preferred inflation gauge, later in the week. So couple big market events heading into the long holiday weekend. Remember, next Monday is Labor Day. Happens to fall on September 1st, so next Monday is Labor Day. So markets are closed. So we get a. I'm looking at it. First rule about Fight Club. Yeah, I don't think, honestly, besides like messing around, wrestling with my brother or one of my kids. I don't think I've ever been in a fight in my life, honestly. So yeah, this one's tough. All right, everybody, let's head over. Let's smash away. All right, let's do it. Everybody here, please, before I go any further, smash, hit the like, subscribe, all that good stuff, because today we are going to talk about the impact of interest rates on the market. And we know, well, at least we hope, at least we think that there is going to be a cut coming up at the September meeting of the next FOMC meeting. So let me bring this in here real quick. Okay, so you can see right now, live, this is where we are. 86% probability. 86% probability of a 25-point basis point cut. Okay, that's been fluctuating a little bit based on Powell, based on some of the inflation data. And again, with the big inflation data we get at the end of the week, this week, and then next Friday, not this Friday, but next Friday, we will get a jobs report. Those two things will be really critical in terms of what the Fed does. Okay, so let's go through kind of some history and talking about how interest rates actually influence the stock market. Okay, well, if rates are higher and there's higher borrowing costs, okay, that certainly factors into business, and lower profitability is often associated with kind of worse returns in the market. And equities definitely tend to perform better in a low interest rate environment. Now, we can all say, why are we at all-time highs right now when rates are high? Well, rates aren't high. Okay, let's really discuss that. Rates at The Fed funds rate at 4.25, 4.5%. Historically, that's not high. Mortgage rates at 6.5 to 7%. Historically, that's not high. Now, coming off of where we were a few years ago and from COVID, sure, that's a major, major difference. But historically, we're not really that high. So we're not heading back to the post-COVID or COVID era of the zero interest rates. That is just not happening, guys. Okay, unless God forbid there's another catastrophe that happens. Okay, we're not going to see rates of 1% again. Okay, now inflation could be settling in here. We know it's, as Powell would say, it's sticky, but it seems to be settling in between 2.5% and 3%. Okay, which they want to see it down at 2%, but the market seems to be okay with that. Okay, so if we don't see that pop up in inflation again, and if the jobs market kind of just continues where it's at, and that jobs number next week is not a really, really strong number, then the projection will probably be to see that Fed funds rate down at about 3%. Now, that's not going to happen all at once. Right now, the Fed funds rate is 4.25 to 4.5. So it could be likely that we'll see 4 or 5 cuts coming up if things continue to be on the trajectory we are now. Now, in terms of like the market cycle, it usually takes about a year or so, okay, for a change in rates to have a big economic impact. However, stock market impact is usually immediate. Okay, and the reason is because the stock market is really a projection of what people think is going to happen in the future. Okay, so that is really immediate, but to flow through the economy, that typically takes about a year. Okay, now, so if we see rates changing, okay, the estimated amount of future cash flows for companies is typically going to drop if a company is seen as cutting back on its growth or is less profitable because of higher rates, higher debt expense. And what part of the market, everybody, I'm going to ask everybody a question. What part of the market over the last week, maybe 10 days, but more likely, a week, which part of the market has rallied the most? I'll wait for some answers here because this is a direct reflection of, hang on one second, everybody. Hang on one second. Thought we were expecting some visitors here. Okay, which I am. Retail, tech. Okay, how about big cap, small cap? Let me ask that. Big cap, small cap. Those are all good answers. But if we look at the S&P 500, if we look at the Dow, if we look at the NASDAQ, and if we look at the Russell, there you go, Kevin. It's the Russell that has outperformed over the last several weeks. It's not the big caps, Bill. It's the small. Okay, Kevin, Aladdin, it's the small caps. Why is that? Well, those are the companies most sensitive to changes in interest rates. Those are the companies that typically need to borrow more and look for higher growth. So the prospect of lower rates, okay, is more of an effect on those types of companies than the big cap stocks. Okay, and so when we see these changes in rates, we're seeing the Russell, the IWM, which is the ETF for the Russell, getting some catch up. Not Heinz or Hunts, but getting some catch up here to the rest of the market now that there may be lower rates in the offing. Okay, now When we've seen some hikes, okay, there are definitely sectors that outperform. Typically, those are the financials, banks, brokerages, mortgage companies. Okay. And why is that? Well, bottom line is they can charge more, right? So the spreads start to widen out. Spreads of what they borrow from the Federal Reserve to what they lend out. When rates are lower, those spreads narrow. So here is a chart. Fed funds rate over the last 20 years, 25 years. Okay. So back in 2000, we saw Fed fund rates almost up at 7%. Okay. They came crashing down. Where's my drawing pen? What do you think happened in the market when rates came down to here? Hello, Jake. We saw a nice market rebound after the dot-com bubble here. We saw a nice rebound. And then when we saw rates up here, what happened? What happened in this time frame right here? And I'm not saying that what happened there was the direct cause of rates being up there, but what happened when rates were up here? That was the great financial crisis, right? 07, 08. S&Ps went down to 666. 666 on the S&Ps. We're now at what? 6,400. So what happened? You know what hit the fan? The Fed had a lower rates, kept rates down for 6 years, 7 years. What did the market do during this time? It skyrocketed. Okay. They started raising rates because the economy was starting to get healthy again. And then what happened right here? COVID. That's where they lowered rates essentially to zero. That was that zero interest rate environment that I was talking about. We're not getting back there. We are not getting back there, folks. I hate to say it. Those of us that were fortunate enough, lucky enough to maybe lock in at a 3% mortgage rate, that's not normal. That's not normal. That's not going to happen again anytime soon. Unless, God forbid, again, there's some big calamity. But seeing these rates come down, got so many lines drawn on there. Seeing these rates come back down to their midline, right? Just like we talk about implied volatility normalizing, right? When it's super low, we know it's going to come up. When it's super high, we know it's going to come down. Same thing with rates. It's the ebb and flow of the economy, of the cycle. So I think it's very likely we're going to be back in that 3% target, which is probably a great thing for the markets. So rates and the market typically move inversely to one another. Okay, just like we talk about volatility in the markets. When the VIX goes up, the markets go down. When the VIX is down, markets are typically going up. Well, it's that same inverse relationship with the markets and interest rates. Okay, and so as rates are rising, there's lower corporate profits. Again, because those companies that want to borrow, okay, they got to pay more. Okay, and the opposite is also true. That as rates come down, they can borrow more, much cheaper, increase their profits. Okay. And then also, as rates are rising, okay, think about it. As rates are rising, there's other places for people to park their money, right? If you can get 5% on a T-bill, right? There's going to be money coming out of the marketplace, out of the equity markets into the bond market. Okay. But again, the flip side of that is when rates are completely low, who wants bonds? Nobody, right? You don't want to lock in at 1 or 2% buying a bond. You'd rather have your money, probably working for you in the equity markets. Okay. Now, before we get to the rest of this here, yeah, let's just go with this today here, folks. I had to pull this one out. That's what my eye really looks like without some of the makeup that my wife put on me. And for those of you that don't know who Kobe is, he's actually laying at my feet right now. Kobe is my wonderful black lab who never leaves my side. And Saturday, he's actually pretty old also and not getting around too well. So Saturday, we had stopped at the grocery store. Friday, we had stopped at the grocery store, and I bent down to help pick him up to get him into the truck. And as I bent down, he jumped up and he caught me flush. He caught me flush. At least that's the story I'm going with. No, that's the truth. All right, so that's our words of the day today. Okay, so we already talked about the two reasons why markets and rates are inverse to one another. Kobe's great. Kobe won. Kobe is a black lab. Kobe is a black lab. I can probably, you know what? I'll put Kobe up as for our word tomorrow. He'll be our mascot tomorrow. Okay, so when rates are rising, and I know I've repeated this multiple times, but it immediately elevates short-term borrowing costs. Okay, all of a sudden profits are dropping. Okay, also if you think about it, okay, if it's not just companies, but you and me and consumers, right? Because if consumers are borrowing money and they now have to pay more interest, less disposable income. They got to pay more for their mortgage, credit card expense, whatever it might be, less disposable income. So not only are businesses paying more from their interest rates increasing, but typically there's less business as well. Okay, typically there's less consumer demand. And then when rates fall, it's really the opposite. Okay, the Fed lowers rates to stimulate the economy. It's the opposite of a rate hike. Consumers spend more when rates are lower. Okay, and when we see lower rates, we talk about when rates are higher, that really the financial stocks, companies, banks, etc., those are the ones that do well. Well, in a low rate environment, utilities and real estate investment trusts typically outperform. Those are more of the safe haven, higher dividend paying stocks. So people will look to go into those sectors, especially for the dividends. Now, here's a comparison for the last same time frame here. Here's a comparison between the Fed funds rate and the S&Ps. Okay, so here we are in the S&Ps. Okay, and here is that right there. That's that 666 we talked about that Mark Haynes from CNBC famously called out. But you can see there really is an inverse relationship here. Okay, throughout time, there is going to be an inverse relationship. So, really, to sum up here, the sky is the limit. um, Interest rates in the stock market summed up. Okay, interest rate, what is it? We all know what it is. It's a percentage charged by a lender on the debt. Okay, and it's for your repayment or reward for saving money at a bank. Okay, interest rates and stocks typically move in opposite directions. Rates go up, stocks go down, vice versa. Now, this is what I was talking about before. Growth stocks and value stocks. Growth stocks are typically those small caps. Okay, those are growth stocks are typically the smaller caps, the Russell stocks that have to borrow more money. So them and the value stocks, they get affected differently by a change in rates. Okay, so without playing, if you're trading interest rate futures or the dollar, you can certainly, if you wanted to take an opinion on the market based on where rates are going, you can look at certain ETFs like the IWM, which is the Russell, the small caps. If you think rates are going down, you want to be in that. Okay, and I talked about how that has outperformed in the last several weeks. Let me bring a chart of IWM in here. Okay, here's IWM. Look at this just over the short run here. This is a very, very short run. So as the prospect of rates falling has really become part of the marketplace, you can see those small caps really, really doing well. And you can also see this, obviously right here, this was Liberation Day where everything got hammered. But these drawdowns here are typically when we've seen the Fed raise rates, which they did here and which they did here. Okay, so again, you can certainly have an opinion, have a bias. IWM is a good one. TLT is another good one to look at if you wanted to take an opinion on rates and what may happen to the market. Let's get last call for the wheel today. That is my left eye. That was a selfie I took. That is my left eye. So in the you can see the camera, I think, right? Everybody can see me. All right, everybody. The wheel is up to on close here, I believe. Left eye. That's my left eye. The picture here. Selfie, right eye. It is my left eye. Okay. I took an eye to a dog fight. Yeah, let's go. All right. Where is our wheel here? All right, got it. Oh, darn, Mike. I was hoping you'd put my black eye in the middle there. I know exactly, Thomas. Maybe for tomorrow. I was hoping that Mike was going to put my pick in there. All right, new week. Everybody is eligible. Let's get it rolling here. Winner is Gene, Gilbert, Greg, Guillermo. Who is it? It is Guillermo. Are you in the house? Guillermo, are you in the house? Please let us know. You got to be here. You got to be in it to win it. Guillermo, are you here? Yes. Wonderful. Okay. Shoot us an email. We're going to put it up here. There it is. prosperswag@prospertrading.com. Email your shirt size, your mailing address, and we will get some swag out to you. Thank you, everybody. Really appreciate it. And we will be ready to go tomorrow. Look for Kobe on the wheel tomorrow. Have a great day, everybody.